Hey everyone, and welcome back to the channel. Today we're going to know if you should buy stocks now or wait. Let's get right into it. Every month, tens of thousands of people search Google to see if it is a good time to buy stocks. It's a loaded question, and the answer is determined more by your investing goals and time horizon than by what the market is doing on any given day. If you have some savings to invest, feel ready to buy stocks, and don't need the money for at least 5 years, then yes, jump in. Even when the market reaches new lows, as it has in 2022, if you're investing for the long term, you'll have time to recover losses. Here's an illustration. In late February 2020, the S&P 500 began a historic decline, ultimately finding the pandemic floor on March 23, 2020, and starting a bear market. Historically, the average bear market lasts about a year, and it takes about 2 years for the market to recover from a crash. This time, however, it recovered in just 149 days. By the end of August 2020, the index would have reached new highs. In 2021, the stock market was still roiled by unexpected events, and the outlook for the United States remained uncertain. Nonetheless, according to Morningstar, the U.S. market grew 9.5% in the fourth quarter of 2021. The point is that marketing timing is ineffective. Instead, decide what to buy and when to buy it based on your timetable for achieving your objectives. Investors are understandably cautious in 2022. Volatility has been caused by record high inflation and interest rate increases, with the S&P 500 briefly entering a bear market on May 20th and again on June 13th. But that doesn't mean you should avoid the market. The market's rapid recovery in 2020 was clearly at odds with the economy of the United States. However, a closer examination reveals that this disparity may not be as perplexing as it appears. The stock market reflects investor expectations for the future rather than what is happening right now. While retail investors are more likely to buy and sell based on daily headlines, institutional investors look ahead, which means that the stock market's performance may not always correspond to current economic conditions. The S&P 500 is also market cap weighted, which means that the larger companies have a greater impact on its performance. Many of the index's larger companies are in technology, an industry that was not as hard hit by COVID-19 in the first 2 years, and those companies pushed the S&P 500 to new highs despite the ongoing economic issues caused by the pandemic. Now those same companies may play a significant role in dragging down the index as investors lose faith in those same tech stocks. It is not as important when you start investing as it is how long you stay invested. That is also a maxim to remember right now. It is simpler for you only to invest for long-term goals. You don't invest money that you might need in the next 5 years because it's very likely that the stock or mutual fund you will buy will lose value in the short term. If you need that money for a big purchase or an emergency, you may have to sell your investment before it can recover, resulting in a loss. Short-term drops, on the other hand, are important if you're investing for the long term. Compounding gains over time will assist you in meeting your retirement or long-term financial goals. Short-term goals can be met with more conservative investments, such as bonds or fixed income investments. These are more resistant to stock market downturns, but typically rise much less than stocks during bull markets. You can tailor your asset allocation, the breakdown of your portfolio between volatile investments, such as stocks, and conservative investments, such as bonds, to different goals and time horizons. One of the best ways to stay calm and invested during volatile times is to treat investment contributions like a recurring subscription, a technique known as dollar cost averaging. Rather than trying to time the market, you invest a specific dollar amount at regular intervals, say once or twice a month. You're buying in at different prices, which should average out over time. So, how do you get started with dollar cost averaging in the market? Combining this with stock funds, such as exchange-traded funds, is a common strategy. Exchange-traded funds pool a variety of stocks, allowing you to gain exposure to them all with a single investment. For example, if you bought an S&P 500 exchange-traded fund, you would own a piece of every company in the index. Exchange-traded funds allow you to quickly build a well-diversified portfolio, rather than investing all of your money in a few individual stocks. You could set up automatic monthly investments into an exchange-traded fund through your online brokerage account or retirement account to dollar cost average. You would achieve the benefits of dollar cost averaging and diversification through this strategy, which is designed to build long-term wealth. So if you're wondering if now is a good time to buy stocks, advisors say the answer is simple, regardless of what's going on in the markets. Yes, as long as you plan to invest for the long term. Start with small amounts, use dollar cost averaging, and invest in highly diversified mutual funds and exchange traded funds. That's it for today. If you guys enjoyed the video, make sure to hit that like button. Don't forget to subscribe and turn on that notification bell so you never miss out on any future content we'll produce for you guys. We're signing off now, but we will be sure to catch you all in the next one.